Over the past 5 years, Singapore's property market has kept climbing up. In 2024 alone, HDB resale prices jumped by 9.6%. That is almost double the increase in 2023. Meanwhile, private property prices were also up by 3.9%. But with a possible recession looming, rising unemployment, and a slowing economy, is the property market finally going to crash? Let's find out in this video. But before I start, do join my 10,000 members Telegram chat group to discuss or ask any questions that you may have. To understand whether a property crash is coming or not, we need to first look at history. In the past, price dips in Singapore's housing markets has always been triggered by major external shocks or policy moves. Here, we are comparing changes in GDP, shown by the orange bars, against changes in property prices, represented by the blue bars. From 1975 to today, there have been 5 major periods when the Singapore's property markets experienced a decline, and in each of those cases, the dip happened either just before an economic slowdown or during the early stages of a crisis. So let's dive into each of these moments to see what they reveal, starting with the property crash in the 1980s. In 1981, property prices saw a sharp and sudden spike in quarterly growth. This surge was largely driven by the launch of the Approved Residential Property Scheme, ARPS, a policy that allowed CPF members to finally use their CPF savings to purchase not HDBs but rather private properties for the first time. And unsurprisingly, this move triggered a surge in demand and sent property prices soaring almost overnight. It was the first time the markets had experienced such rapid growth, and unfortunately, the governments lacked the tools and experience to prevent a bubble from forming. Prices quickly peaked in 1981, and without intervention, the market soon began to dip, leading to a correction that lasted all the way to 1986. Quick pause. Weibo is running a welcome promo where you can get up to $600 in rewards. But first, here's why Weibo might be worth your time. First up, Weibo lets you invest in US stocks and ETFs from just 50 cents per order with zero platform fee during regular and extended hours. And if you often trade a large amount, Weibo is also offering an optional fixed commission plan where you'll be able to invest in US stocks and ETFs for just 90 cents per order for 180 days when you select this plan and make an initial deposit during the campaign period. And for the other markets, their pricings are one of the most competitive as well. Weibo isn't just a trading platform. It is loaded with features such as advanced charting tools, real-time news, analyst ratings, and both technical and fundamental analysis. Perfect whether you are just starting or are already deep in the game. New users who sign up to Weibo now will get up to $600 in rewards when you deposit a minimum of $100,000 by 30th September 2025. 3:59 PM Singapore time, and maintain the funds there for 90 days. You can also park your idle cash with Moneyboo and earn up to 4.18% 7-day USD yield per annum. So if you are interested, do sign up to Weibo using my link down below. And let's get back to the video. To make matters worse, by 1984, the construction market had become saturated. Most major projects were already underway or completed, and new development activity slowed significantly. This oversupply added further downward pressure on prices. At the same time, Singapore was also hit by its first post-independence recession in 1985. The economic downturn led to business closures, rising unemployment, and a general loss of consumer and investor confidence, further dragging the property market down. Over the course of 20 quarters, the property price index fell by a whopping 40%, making it the largest and longest correction that the Singapore property market has ever seen. The next property dip came in 1996. This time, it was caused by a number of cooling measures. This included capping loan-to-value ratio for property loans at 80% of property value, banning foreigners from getting home loans denominated in Singapore dollars, introducing an early version of the seller stamp duty, which taxed profits if a property was sold within 3 years of purchase, as well as the government releasing more land for private housing. And just as these measures were beginning to take effect, the Asian financial crisis hit in 1997. The crisis led to widespread currency devaluations across the region, plummeting investor confidence and causing rising unemployment. As a result, the property downturn deepened. However, compared to the crash in the 1980s, this correction was shorter and less severe. The decline lasted 10 quarters and prices fell by about 30%. Even more notably, the markets bounced back relatively quickly as the recovery took just 6 quarters. Then, just a few years later, the property market was hit by another downturn, this time triggered by a series of global shocks. First came the dot-com bubble bursting in 2000, which sparked a global recession. Then, in 2001, the September 11 terrorist attacks further rattled global markets and investor confidence. This double shock reversed the earlier recovery and pushed Singapore's economy into contraction. GDP shrank and the unemployment rate rose to a 15-year high of 4.7%. Then, because the economic conditions were more prolonged and uncertain, the property market dip lasted longer, over 16 quarters. However, this decline was less steep than the previous downturns. The property price index fell by 21% as compared to the 30 to 40% declines in the earlier crashes. Still, it took close to 4 years before prices recovered. Then came the global financial crisis in 2008, which triggered another property market correction. This time, prices fell by 26%, slightly worse than the previous downturn between 2000 and 2004. However, by this point, property buyers had started to recognize a pattern. Singapore's property market had a strong track record of bouncing back after downturns. That growing confidence helped limit the impact. As a result, this dip lasted only 5 quarters, and what followed was one of the strongest rebounds in history. Between 2009 and 2013, property prices soared by 53 index points, reaching another new all-time high. That's when the government started to step in and introduce a series of cooling measures, including additional buyer's stamp duty, total debt servicing ratio, and tighter loan-to-value limits. These measures gradually took effect, leading to a mild market dip around 2016 to 2017, before property prices started going back up again. Finally, the last dip happened in 2020 during the pandemic lockdown. During that period, home prices and transactions dropped as agents were unable to conduct viewings, show flats were closed, and market activity was constrained. However, this dip was very mild, as it lasted only 1 to 2 quarters, and the index only fell by 1%. And as soon as the lockdown was lifted, home prices shot up again and continued their upward trajectory all the way till now. So what can we learn from all these episodes? Firstly, property price dips in Singapore almost always coincide with major external shocks, whether it was the 1997 Asian financial crisis, the 2000 dot-com bubble, or the 2008 global financial crisis. Secondly, over time, each dip has become progressively smaller and shorter. This could be due to the growing confidence in the safe haven status of the Singapore's property market, as well as the government's increasingly proactive use of cooling measures to manage speculation and systemic risk. In fact, after the introduction of total debt servicing ratio, which prevents homeowners from over-leveraging, price volatility has significantly reduced. This suggests that the property market is not only more resilient, but also more grounded in fundamentals, with buyers generally borrowing within their means and investors taking a longer-term view. Case in point, from 2013 to 2022, Singapore property market stands out for its stability and lower volatility when compared to other major cities, such as Hong Kong, Sydney, New York, and London. Which brings us to the question, given that there's an ongoing major trade war now, are we headed for another correction? Thankfully, not yet. Though, there are a few signs that are pointing to the market cooling down. First, property price growth is slowing down. Here, you can see a clear trend of the growth declining. In the latest quarter, the private property price index only rose by 0.8% as compared to the 2.3% growth seen in the previous quarter. As a result, DBS has also revised its price growth estimates for 2025 to be between 0 to 1% versus its previous projected range of 1 to 2%. Meanwhile, on the HDB side, the resale price index has also came down from 2.6% in the previous quarter to 1.6% now. Second, the transaction volumes in the private resale markets have also been dipping. This usually signals that buyers are becoming more and more cautious, and a slowdown in volume often precedes a softening in prices. Third, there's a growing disconnect between property prices and household incomes. Between 2020 and 2024, private home prices rose by around 33 to 40%, while median household incomes only rose by 23%. This widening gap has caused Singapore's price-to-income ratio to climb to 14.6 times in 2024, signaling that private housing has becoming increasingly unaffordable for median-income households. In particular, median price-to-income ratios in the OCR and RCR have continued to rise. This suggests that the affordability issue is now affecting the mass market as well, and not just luxury buyers. And amidst all these domestic issues, there is now slowing global and regional trade, as well as heightened economic policy uncertainty.
No thanks to someone.
Because of that, Singapore has downgraded its GDP growth forecast for 2025 to between 0 to 2%. This is a sharp drop from the 4.4% growth that we saw in 2024. This prompted the governments to even caution that Singapore may or may not enter a recession this year. However, even if a recession does occur, any dip in the property market is likely to be mild, and here's why. While interest rates did spike in 2022, rates have since eased back down and are now hovering just below the 3% range. This means monthly repayments have not just become more manageable, but is also helping buyers re-enter the market. Supporting this trend, the non-performing loan ratio for housing loans remained low at 0.26% as of Q3 2024, indicating that most homeowners are still servicing their loans well. However, there are signs of stress starting to surface. In Q1 2025, mortgage sale listings ticked up, prompting Knight Frank to caution that this may be the calm before the storm, especially if a sweeping global tariffs and a looming trade war escalates. Looking ahead, private residential completions are expected to fall well below the 10-year average of 12,000 units annually. At the same time, vacancy rates have been trending down, especially in the OCR. This combination of limited future supply and shrinking vacancies points to a tightening market, which could act as a buffer against price declines, even if economic conditions become less favorable. On the demand side, local buyers continue to dominate the market. In early 2025, Singaporeans accounted for 92.4% of new home purchases, while PRs made up 6.9%. Only 11 units or 0.7% were bought by foreigners. This is a clear sign that domestic demand is still driving the market. And the major driver to that is household formation. Every year, Singapore would see around 27,000 to 28,000 marriages, representing a consistent stream of new households entering the market. Meanwhile, rising median household incomes have continued to support affordability, particularly for HDB upgraders and middle-income families aspiring to enter the private property market. In short, while there are early signs of a property market cooldown, like slower price growth, falling transaction volumes, and a small rise in distressed sales, there are still strong structural supports holding things up. These include limited new supply, solid local demand, and relatively healthy mortgage conditions. That said, if a global recession or trade war intensifies, we could see higher job losses, weaker consumer confidence, and tighter credit, all of which will put downward pressure on the market. So don't just go YOLO into a $1 million HDB or a new launch condo just because your friends say,
Confirm go out one.
When things go south, they won't be helping you with your monthly installments. At the end of the day, always budget carefully, buy within your means, and think long term. Anyway, that's all for this video. Hopefully you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.